Before we start, please take a moment to read through this disclaimer. Here's a summary for you. All the content in this meeting is for informational purposes only. You should not construe any information or other material as legal, tax, investment, financial, or other advice. Any trades or specific companies discussed during the session are examples and should not be taken as a trade advice. All the content is of general nature and does not address the circumstances of any particular individual or entity. Before acting on any information you gather from this session, you must consult a professional advisor to confirm if the action is appropriate for you. All right, let's get started. All right, once again, thank you for tuning in. Today is December 8th, 6 p.m. Pacific time. I welcome you all to our first session of Options Bootcamp. So this is the third session that I'm doing in year 2020. So all right, so a lot of things to cover, so let's get started. So we will jump into what's an option contract and understand the all the details. But before we go over there, a little bit about myself. I see a lot of new names. I know some of you have been in touch with me for quite some time, but I do see a lot of new names. So a quick introduction about myself. Who am I? I have had experience in the software industry, more than 2 decades, working in fintech and data management space. And I've also been on the side a small business owner in Bay Area for almost 7 years. So I do know something about accounting and bookkeeping because I have to do it for my own business. And then, of course, I've been trading options along with my job for more than 4 years, that too on the side. Okay. Overall investing experience, almost 15 years. 10 years in US, 5 years outside of US. My philosophy is to think risk before rewards. I always want to know, look at the worst situation so that we are prepared for it. That's my philosophy. I'm not the one who's looking to hit it out of the park, irrespective of what the risk in a position might be. And I am located in San Jose, California. But until this whole COVID stuff goes away, you will always find me only on Zoom sessions. Oh, I miss those days when we used to meet face to face and used to have some good discussions. Hopefully those days will be soon. But until then, you can find me on Meetup and we can continue to meet virtually, socially distanced on Zoom. All right. What am I not? I think it's important to understand who am I, but also what you won't get from me or what you won't see from me is I'm not, one of the person who was burdened under debts and paid off all those big debts using income from options trading. You go out and Google for learn option trading, you will find hundreds of option trading videos and all claiming people how they were distressed, financially distressed, and how did they use options to make moolah and get out of those debts. I wasn't one of those. Okay, so you won't hear those stories from me. I don't have any stock chart indicators to give you that will make you master of stock investing. It doesn't mean that there are indicators I don't use any, but I know for a fact nothing works in all market situations, right? So if you are here to get some quick indicators that you can stick up on your trading platform and that's it, and you become master of stock investing, sorry, I'll disappoint you in that case. I don't have a mansion, I don't have a private jet, I don't own a yacht or fancy Lambo. I don't have any of those things. So I drive a decent car and live in a small house in Bay Area. So you won't see me flaunting and talking about how I use options and I got this new car or a yacht. But you will see me talking about how you can use options, maybe to supplement your current income, especially if all of you were in the same position like me, that you got a job or a business to take care of, and you want to add and supplement your income, then how you do it? I've been using options. Okay. So how did I get my start in options? It was around 2016, when the stock market was all-time high. Now if I look at that, all-time high was, I guess, around 210, 220 S&P. Today S&P crossed another all-time high, more than 370. But it was at all-time high at then, right? So, and that got me worried about elections are coming up. Our current president was running for elections, and there was a lot of volatility that you would expect in the elections. So I have lived through the financial crisis of 2000. I lived through the crisis of the great financial recession of 2008, 2009, and I've seen how the paper profits in a portfolio can just evaporate. Right? So I was getting worried about my portfolio, and I was thinking, should I sell and take the gains, get out of market, or should I still hold and risk it in election volatility? That's where I started to research in order to find out how can I protect my portfolio without taking, gains and paying capital gains tax on it, and still stay in the market. You never know where the market could go. Irrespective of what our opinion is about the market will do what it wants to do. It doesn't matter what we think or what, I guess, anyone thinks. So I started researching, came across options as a portfolio protection. But as I studied more and more, got deeper into options, I realized it could be used for, income generation as well. And since then, I was hooked onto it. So it's been a great journey, good learning for more 4.5, 5 years. And then it is only from this year onwards, I started sharing what I'm doing. So we started with a group of close family friends. We've known each other for years. A couple of you are in this meeting. And then we expanded the group to a few more people who are now connected on various other, through other means. And this is the third boot camp that I'm starting again. So outside of this session, you can connect with me and stay connected through various other channels. Some of these are, we have our Slack channel where many of us are, are connected. So there's a Slack channel we have. We kind of share ideas. We talk about, with other people, validate, look at what's happening in market and things like that. So you can connect me there, or you can also connect it through podcast. I started doing podcast close to do almost 50 episodes. So you can connect through podcast. We are available on Apple, Google, and Spotify. You go there and search for OptionGig. You should be able to get to the podcast. Choose whatever platform you want to choose. It's available on almost all podcast platforms. Or you can connect through me on a YouTube channel. There are a bunch of videos over there. We still have to, put more content, but we're going there. Or you can connect me through Quora. I'll provide you the links. I'll put it in the chat. If you're interested, connect me through Quora. I do get onto Quora, once in a week and look at the questions and do respond to those. Or you can be on my website. I just session timed out. So again, OptionGig.com. You will see many of these content being posted on the website. And there are some tutorials on the website. And of course, I also share some of the stuff that I do. Lastly, I'm on Twitter. This is my least active one. But if you enjoy Twitter, maybe you connect with me, poke me, prod me, I'll become more active. But these are the other ways to stay connected with me outside of this bootcamp webinar and also outside of our Saturday sessions. So I generally have one session on Saturday where we talk about general markets. What am I seeing? What's the news? How we can make use of what we're hearing in market, talk about investments, talk about option strategies, look at the trades. And this bootcamp is solely focused on education around options. Saturday's session, we talk more about the real trades. We reviewed IPO, we review the mega trends, and anything and everything about investing is what we do on our Saturday session. All of you have come through Meetup, so you should be able to see those Saturday sessions already scheduled. So let me just give you the links in case you are interested in connecting with me through other channels that I just showed. Okay. All right, so these are the various ways you can stay connected with me. Before we get into today, quickly want to give you an overview of what all we're going to talk about in this bootcamp, right? We're going to talk about the basics of option contract. We look at the first strategy called cash secured put. And for now, I'll just ignore these names. I'll explain these fancy names in details. They're pretty simple. It just need to have some explanation. We're going to talk about call options and then covered call strategy. We're going to talk about a concept of moneyness, in the money, out of money, at the money. We're going to look at how the whole exercise assignment process works. We'll give you the checklist so you can follow before opening an option trade. If you are having a small account, then what are the things that you could do using options? I would say it's a misconception. If you hear people saying options are only for people with big money, it's only for institutional investors or only professional investors should do it. No, even if a small account, there are strategies that you can use. We're going to talk about that. We're going to talk about some multi-leg strategies, look into option pricing. And now this is where we start getting into little more detailed, deep dive into options, right? How to manage if things are going wrong, get in little more stuff called option Greeks to understand how the pricing happens, how the Greeks can affect your positions, and how to do risk management using options. Lastly, how to use options to manage your portfolio. So we'll start from an individual trade level, move over to a particular company level, then move over to at a portfolio level or of how you should use options to manage your portfolio. And lastly, tips and tricks for specifically those who are part-time option traders. So there is tons of content available on Google, on YouTube around options trading and education. The only concern which I had when I was going through it, that most of the content was for someone who is doing it for a full time. Some of the strategies or some of the kind of trades that were being done would need too much of a babysitting, and that just wasn't working out for me because hey, we got a job to do, got a family to take care of, got a couple of kids who I need to drive around for their classes, after school, and got a business to take care of. And so I can't devote whole time. So then I started kind of developing and focusing on what we can do being part-time option traders. And that's what I'm here to share with you. So if you are already a pro or a full-time option trader, you might find some of these things not really interesting or intriguing for you because we're not going to get into those details of, for example, I'm not going to share with you the second order Greeks, right, VOMA, etc. I'm not going to share with you the Black-Scholes model and how you can derive option pricing. No, we don't have to worry about it. We are not professional traders. We are not market makers. We are professionals who want to earn income using options or protect portfolio using options on the side. So we'll ignore all those intricacies which generally scare people away. And that's my intent. to see, if I can share that with you. All right, so today we're going to talk about very basic of an option contract. So what's an option contract? It's a legal contract between two parties, A and B, in which one party, say A, agrees to buy or sell a security from other party B. But the price is predefined in the contract, and that contract is valid only up to certain date, right? So it's like if I'm transacting with Jane and I agree, in which I say, Jane, I'll buy this shares from you at this price all the way before January 15th, whenever you want to sell it. So that is an option contract. Okay, we'll dig a little more deeper into this with some more examples. So to make it more clear, there are two types of option contracts you would see: call option, put option. Every other type of option strategy, and there are many, you can go as complicated as you want to, are being built upon just these two basic option strategies: call option, put option. And if you can get a good understanding, if we can master put and call, then using those two Lego blocks, we can construct whatever type of house we want to. We can construct iron butterfly strategy. We can construct strangles, straddles, iron condors, Batmans, jade lizard. There can be many names, many fancy names you can give. But the fact is, the building blocks, if you dissect any of those strategies, in the end, like in any object, you got proton, neutron, electron. Here you got put and calls at the end. So these are the two building blocks. We will spend maybe first 2 sessions of boot camp only on these two and look at an option strategy in which we use these two. So let's try to understand how the option contract really works, but without talking about options. So I want to take an example which we all are very familiar with, which is house. Some of you might have gone through the whole process of house buying. Some of you have already owned the house. So here we are taking an example in which Martha, she owns a home which is worth $500,000. She's definitely not in Bay Area. To protect her investment in her home, she wants to buy an insurance policy because she thinks, house could get damaged in snow, in hurricane, in flood. So what happens? Matthew comes along and Matthew offers her a policy for 1 year and insure the house for $500,000. Means Matthew will enter into a contract and tell Martha that I'll buy your house for $500,000 whenever you want, but up to 1 year. But I'll charge you a premium of $40,000. You will have a privilege to give this house to me at $500,000. But for that privilege, you will have to pay $40,000. So what happens? Matthew will write that insurance policy. I mean, we all are familiar with this. Those who are homeowners get an insurance policy. Those who are vehicle owners, we get car insurance policy. So Matthew writes the insurance policy. Martha buys the policy. And Matthew gets the money. That's the end game. So what we just witnessed is type an option contract. But the question is, why would Martha do this? Right? People generally say, is option trading or option investing, is it a zero-sum game? In my opinion, it is not. And let's look at why it is not a zero-sum game. What did Martha gain from this? So Martha's viewpoint was, if a house suffers damage, I can still sell it to Matthew and get back my $500,000. So she bought peace of mind. She don't have to worry about her asset, which is $500,000. She protected her asset by paying some premium. Why did Matthew enter into this transaction? So Matthew's viewpoint was, he's an insurance guy. He's got his colleague who's an actuary, can go back and look at the data of how much the damage could happen to a house in this area, in this zip code, house with this sort of a construction, and house which has been built in this time frame. And Matthew knows that the statistics show that most of the time the damage to such house will be less than $40,000. So if Martha sells the house back to him, he can get it repaired in an amount less than $40,000, sell it back for $500,000 and retain the remaining money. So the remaining amount becomes profit for Matthew. So in this transaction, both the parties have their own valid reasons of why they entered into this transaction. So it's not a zero-sum game. Both the parties have something to gain from this. So whatever we just saw, which is what we do every day in our lives, is an example of a put option contract transaction. Okay, so let's break it up. So what did Matthew do? He wrote a policy. Let's call the policy that he wrote an option contract. He sold it to Martha. And as per that policy, Martha can sell or can put the house to Matthew, right? Martha is putting the house over to Matthew at $500,000. And I'll come back to these terms. These terms are specific to option trades. When you're looking at any option trade, you will hear or you will see the fact, what's the strike price? What's the period? What's an expiration period? What's the premium? So I'm just trying to dissect here and say these transactions that we all are familiar with and we all enter every year, either for our car or for our house, it's nothing but an option contract. It's a legal contract. So as per this, Martha can put the house to Matthew. Matthew is a seller of contract, right? He's a seller of the insurance policy. And she can put the house to Matthew at $500,000 because that's the price that they agreed upon, which is called a strike price in any option contract. Within 1 year, this privilege is valid only for 1 year. After 1 year, when the clock ticks over in the midnight, it's gone. If your house gets damaged a minute after the midnight, sorry, your policy expired. You don't have that privilege anymore. So this is valid only up to a certain date and time, and that is called expiration period. Now, for this consideration, for getting this privilege, Martha had to pay $40K premium to Matthew. And we will look into, one of an option chain and create an option rate, which is exactly like this. We'll talk about all these elements. So this is an example of a put option contract. I took an example from real estate or an insurance because most of us are very familiar with how these insurance contracts work. Okay. So what is a put option contract? It's a contract that gives the buyer of the put contract, buyer of the option contract, an ability to sell the stock. Okay, just to differentiate between the buying of a contract or buying of a policy and buying of what that policy protect. In real estate case, you buy an insurance policy so that you can sell the house. In stock cases, you buy an option contract which will give you ability to sell the stock at a specified price within the specified time period. For this choice, the option contract buyer, in this case, Martha was the buyer of the privilege. She was the buyer of the contract. She was the buyer of the policy. The buyer has to pay premium to the seller or to the policy writer. Like in the insurance case, it's the insurance company that is the policy writer. In this case, the option seller or option writer, you will see these terms used interchangeably. So when they enter into an option contract, the buyer of an option contract pays a premium to the option seller. But then option seller is obligated to buy the stock at the specified price that they agreed upon in the contract. Any time when the buyer chooses to exercise her right, right? He got a premium. Matthew got a premium, and along with the premium, then he is obligating himself that he will buy the house at $500,000 whenever Martha chooses to sell the house on or before the expiration date. So to enter into that obligation, because he's putting himself under obligation, he got money, he got a premium. So let's look at the option contract main elements, right? Number one, in any option contract, and I'll open up my trading platform, I'll show you, some of these elements so that it is clear. By the way, the trading platform which I will be using is Think or Swim from TD Ameritrade. You could be having different one, but irrespective of what trading platform you are on, what brokerage you are working with, every option contract will always have minimum these elements. Number one, the contract will define what stock are we talking about? Which house are we insuring? What's the house address? Is it Snap? Is it Facebook? Is it Google? Is it Caterpillar? What stock are we insuring against? One thing which is important in options is that one option contract has got 100 shares underneath it. Generally. Later sessions, we can talk about what happens if the stock splits or if there is a reverse split. Those are very different scenarios. But generally speaking, one option contract has got 100 shares in it. That doesn't mean that every option contract behaves like 100 shares. We'll talk about that when we will talk about delta. But for now, let's know one option contract has got 100 shares in it. Date of expiration. How long is this contract valid? What is the strike price? In a house case, it was $500,000. In Snap, if you want to enter into an option contract at 45, you could choose to enter at 45. Doesn't really matter where the stock is currently trading in market. You can pick up at what price you want to protect or at what price you're okay to buy. It will tell you what the type of the contract is. Is it a put or is it a call? And then lastly, what's the amount of premium involved in this? So these are the basic main elements of any option contract. I do see a question. The question is, in a bear market, does the stock owner have to pay the premium instead to lock the price? It doesn't matter whether it's a bear market or a bull market. If you're an option contract buyer, you always pay a premium. Option buyer pays a premium, option seller gets a premium. That's it. It has nothing to do with the market direction or where the market is going. If you are buying something, you're getting a right to do something. You're getting a privilege to do something. Nothing is free in this world. To get that privilege, you gotta pay money. And the person who is giving you the privilege, he gets the money. He or she gets the money. So the seller of an option receives the money. The buyer of the option gives the money. So hope that answers. Okay. I know sometimes they get confusing because, again, these are two different things, the options and the stock underneath it. Just like the insurance policy and the house are two different things. You can buy or sell the insurance policy, right? Mostly us, we buy insurance policy and the agent sells the insurance policy. Similarly, in this option contract, you can buy and sell. You can do both. You can buy and sell the option contract. But what that contract does to the stock or what privilege it gives you, that could be different. And that's where the call and the put, that's the type of a contract which will define what privilege do you hold if you are buying it, or what obligation do you have if you are selling it. If you're selling a put, your obligation is to buy the stock when it is put to you. Matthew sold a put option, or let's say a put insurance policy. He obligated himself that he will buy the house when Martha wants to put the house to him. Call is different. Okay. So we will talk about call later. Today, I just want to focus on put and the one very basic trading strategy using put. Okay. Hope till now it makes sense. Let's move on. Other thing quickly want to talk about is, I briefly touched upon it, that if you are an option buyer, you have a right. And it's called, you have a right to exercise it, right? If I'm an insurance policy buyer, I have a right to exercise the terms of insurance policy. In case of the example that we saw, the terms of insurance policy says, I can put the house to Matthew for $500,000. So buyer has a right to exercise the contract. The seller, they will be assigned the contract. They have an obligation to perform as per what they agreed in the contract once that contract is assigned to them. Okay. So these two terms you would read or you would hear is exercise and assignment. If you are buying an option contract, then you have to go through exercise process. If you are selling an option contract, you have to keep in your back of mind that when can you get assigned the contract. If it is not exercised, contract will expire worthless. Take our example. Nothing happens to the house. It's all sunshine. No rain, no sleet, no snow, no floods. House is cool. Why would Martha sell the house back to Matthew? She had an option. She had an insurance policy. She had an option to sell the house to Matthew, but she chose not to. So the contract expired. Unless she wants to renew it for the next expiration period. In that case, if no action happens, contract is said to have expired worthless. the buyer didn't exercise, so the seller was never assigned. Whatever initial amount that the buyer had paid to seller, that remains with the seller. Okay. So these three terms, keep in the back of your mind. I'll talk again and again about it in the subsequent sessions. Exercise, assignment, and worthless expiration. By the way, there is one session which we will cover the whole exercise and the assignment process and how it actually works in real life. All right, so let's talk about put. Till now, we understood that if you're buying a put, or you call it as a long put, right? You might hear terms. Somebody is shorting the stock. That means what? That means they are selling the stock. Similarly, you can buy the put or you can sell the put. Yes, you can buy a put or you can sell a put. Like I said, in insurance world, we always buy the policy, but in option world, you can be on either side of the trade. You choose what you want to be. It's a level playing field. So you could buy a put or you could sell a put. So now we're looking at what happens when you buy a put. It's also called that I have a long put. So buying a put contract, if you buy a put contract from someone, so that gives you the buyer of the put contract, what it gives you? It gives you a right to put the stock to the option seller. Going back to our example of Martha, Martha bought an option contract, insurance contract, but by now it should be pretty clear that that insurance contract is almost equivalent to an option contract. So Martha bought that contract. She bought the policy. She got a right to sell the underlying house to the policy seller. So if you are buying a put contract, you're earning a right to sell the stock. Take your time to understand that buying a contract gives a right to sell the stock. It took me time, so I understand completely. I had to actually draw a matrix just to get the things in my hand. What am I buying? What am I selling? Because for years, if you've always traded in stock, and now we are adding one more layer, which tells us what we can do with the stock. So could get sometimes tricky, so it's okay. Take your time. So when you buy a put contract, it will give you a right to sell the stock at the price that you agreed upon, anytime on or before the expiry of the contract. For this, you pay a premium. Selling a put, also referred as short put, works the other way around. It means now you are selling an option contract, you become an option seller. What happens if you become an option seller? You're actually giving right to someone else. Right? Now you have become Matthew. You gave right to Martha to put the house to you. So when you're selling a put contract, you are giving a right to someone else to put the share. Remember, the buyer has a right to put the share. The seller of the contract doesn't have a right. But the seller of the contract has an obligation to buy the shares when those are put to you. In this case, you are Matthew. So you are giving away your right to the buyer of the contract. I mean, you don't have a right. You basically have an obligation. The buyer of the contract has the right to put the stock to you at the price specified, because you guys agreed upon a price. And you guys also agreed upon till how long will this contract be valid. But because you obligated yourself to buy the stock when it is put to you, you get a money upfront. Matthew got a premium upfront because Matthew obligated himself to buy the house at $500,000. For taking on that obligation, Matthew received $40,000 upfront. So if you sell a put contract, you receive a premium upfront. But along with that premium that you received, along with the money you received, there is no free lunch. You also have an obligation to buy the stock when it is put to you or when it is assigned to you. So whenever the option buyer choose to exercise her put contract, you will be assigned the put contract, and then you will have to buy the stock if you are selling a put. Okay. So this is the very basic, and I think everything about what a put is. I see a question. If I buy a put option and the price of the stock goes down and I want to exercise the option, how do I get those shares? Do I have to buy and then put them? So if you buy a put option and if you exercise, means then you have to sell the stock at that price that you agreed upon. You would not buy a put option. You generally don't buy a put option if you don't have the shares. Only you will buy it only in the case when you're playing it from a short thesis. So for example, if you bought a put option, means let's say you bought a put option on Snap at $45, means you earned yourself a right to put the stock at $45. If the stock goes down to $40, then you will exercise your right. You will buy the stock from the market at 40, exercise your right to put it to the option buyer at 45, and you earn $5 as your profit. Okay. Now this is how in theory it would work. In actual, you may not even go through rights. You could just pocket the difference. Why go through the whole process? Just give me $5, right? And those are the things we'll talk about later. But if you really want to go through the process, this is what it would be. If you bought a put option, stock goes down below your strike price, you buy the stock from the market at the strike price. But remember, you are holding one contract which allows you to sell the stock at 45. Don't care what the stock is in the market at. Stock is at 20, worked out great for you. You can buy it at 20 and still can sell it at 45. So that's how you would do it. Then you would buy it from a market and then exercise your right to sell at 45. Hope that answers it. I see another question. Let's say I bought a put and then sold it in a few days. Are you saying I'm obligated? No, if you bought a put and then you sold the put, then you close the transaction. Then you have no open option trade available. But the slide which I was referring to is I don't have any put. I just sold a put. And this does get confusing because in stock world, you could sell anything without even owning that stuff, right? People sell, not retail investors. Professionals sell shares at a short, right? They are short shares. I don't have to own Google shares to sell it in the market. I can sell short. I will open up a trading platform and I'll show you how you can sell a put. And we're gonna actually talk about the selling a put in the second part of today's session. So we really don't have to have a put option contract to sell you. You become an insurance provider. You take on the role of Matthew, in which you're selling a put contract. And I'll talk about a use case, why you should do it. That's our second part of this session. So hopefully this helps. So it is called the shorting the put. Shorting the shares and shorting the puts are two different things. So stay with me. I'm going to talk about how selling a put can help you as a stock investor, right? I'm not looking everyone out here, everyone to become purely option traders. I'm not yet. I don't know why. And I'm sure those who are professional traders, they'll tell me, why do I own a stock? Sometimes I think, why do I own a stock? Because everything that I could do with a stock, I can completely replicate using options. Old habits die hard. I still own stocks. I'm trying to reduce my stock position. So I still want to talk about, options, assuming that we will continue to own stock. We just want to use options to get a better return on the stocks. That's the whole purpose of in the bootcamp. I'm going to focus my discussions only on that. Okay. So we'll talk about it. All right. So takeaways from this one. Option contract is a legal agreement. Once you have bought or sold an option contract, you can't back away from it. You have to close the contract. I mean, if you bought a contract, you can sell it back. If you sold a contract, you can buy it back to close the transactions. But if you're still holding an option contract all the way to expiration, remember it is valid up to a certain date. Then if you are seller, you get assigned, you need to do your part, what you've obligated to. If you are a buyer, you have a right, you can choose whether to make use of your right or not. But it's a legal agreement. Buyer has a right, seller has obligation. So buyer will exercise the right. Instead of will, I should put buyer may exercise the right. Many times buyer may not even exercise its right because it's not profitable. And seller will be assigned the obligation. They will be assigned the contract and they have to do their part, what they've agreed upon. If it is not exercised, it expires worthless. Every option strategy, however complex it might sound, however fancy names it might have, is built upon puts and calls. That is why we're going to spend 4 hours just talking about puts and calls. Today, we're only going to talk about puts. Next session, we will focus on calls. All right, this brings us to the end of the first part of today's session. Any questions? Do let me know. Otherwise, I will sip some water and then we will jump on to the second part, which is how to acquire some shares at below the current market price. And I know, don't come and tell me, we already know it. We know how to put a limit order. I'm going to talk about, is there a better way than putting a limit buy order? So stay with me. Someone joined late. Will there be a replay for the session? I am recording it, but it generally takes some time before I could put it up onto my website, but it will be available on my website. So ping me on Slack. I'll try to get it out, let's say by this weekend. So ping me on Slack and I can then tell you, once it is uploaded. But yes, I'm recording it so that I can upload it. Question, are there market makers for options similar way they operate with stocks? The market makers in options are way more than in stocks. Options market is also very liquid. So things like, so let me take a step back and talk about this. So overall in the world over, the most money, dollar amount is in the bonds market. Then comes is a derivatives market, which is options or futures. There is a more dollars being traded in the derivatives than in the actual stocks. I don't have the numbers on top of my head, but the overall the transactions, the dollar amount of the transactions that happens in the stock is way less than the amount of transactions that happens in options and futures, which are the derivatives. So options is a very liquid market, and there are tons of market makers. Now you have to check which stock are you interested in, and that we will cover when we'll talk about our option trade entry checklist. Is how to select a stock which is liquid enough for your option trades. Same is the case with the stocks, right? If it is very thinly traded stock, you would see that the bid-ask spread is too wide. Same will be the case in options. If it is thinly traded stock or thinly traded options, the bid-ask spread will be wide. But yes, there are market makers that exist and provide liquidity to options market. Options and futures market are way bigger than the stock market. All right, let me bring up the second deck and we will talk about the second topic. All right, no further questions? All good? Okay. All right, so let's talk about one option strategy which will help you to acquire the shares at less than current market price. And this is the time when I'm gonna bring up my trading platform also. Okay, let's take an example. And this pricing probably is now off because I kind of took this data on weekend, so it reflects the Friday end pricing. I am long-term bullish on Snap. Not on the Snap app, I don't even use it, but let's say if I'm long-term bullish on the stock of Snap. And again, this is no recommendation. Everything that we are doing today is only for our education. Even though I might bring up some tickers, we might talk about some option trades. Those are not recommendations from me. And don't think that I'm really bullish on Snap. This is just an example to clarify it. So for example, if I'm bullish on Snap, I don't mind owning Snap, but I feel at $48.10, I think it's too high. Let's look at where Snap has run up. Right here, let me bring up Snap. There we go, Snap. Let's say if today now it is 50, but in any case, just an example. If you think 48 is too high because it's got a nice run up, so you are long-term bullish, but don't want to buy it at 48.10. You have money in your portfolio. You got $4,500 and you are okay to acquire 100 shares of Snap at 45. This is a scenario we've gone through for years whenever we have been trading stocks. I want to buy a stock. I don't want to buy at where it is currently trading. I want to buy it at a price which is slightly less than where it is currently trading. Right? My portfolio has got $4,500 cash. I got the money to buy 100 shares. So what I'll do, I'll put a limit order to buy Snap at 45. All of us have done that. This is the first thing we do, is to go and put a limit order, because currently trading at 48.10, if I sell a market order, I'll have to buy it at 48.10. I don't want to buy it at 48.10. I'll put a limit order saying buy Snap at 45, and then I can define that order is valid for today, that order is valid for next some platform actually provide the ability to say next 60 days, or is this order valid good till canceled? Till I cancel it, this order is valid. Everyone familiar with this? I'm assuming if you have traded stock, you would have used limit buy order. This is what we have always been doing it. Here is another one. And I'm saying instead of putting a buy limit order at 45, sell a put option at 45 strike price. Now rewind a few slides back. When you sell a put option, what could happen? Worst case, what could happen? You are taking on an obligation to buy the shares at 45. You are selling an option. It means you are taking an obligation to buy the shares at 45. Whoever has bought the option contract, whoever is a buyer of a put contract, can put the shares to you at 45. But this is what you want to do anyway. You are okay to buy the shares at 45. If you put your limit buy order, you will buy the shares at 45. If you sell a put option at 45, you are taking on an obligation to buy the shares at 45. So from your perspective of at what price do you want to buy the stock, nothing has changed. If you are okay to buy at 45, I am saying instead of putting a limit buy order, try selling a put option at 45. Now let's see what happens. So if you sell a put option at 45 for 15th January 21st, and this is the data as of Friday, so a little outdated, but for this example, this should suffice. If you have a snap, this is in any trading platform. If you open up, you will see an option chain. We'll get into the details of option change in subsequent sessions, but right now just want to share that on the right hand side, it is put. I picked 45 strike price, and I'm saying this contract is valid. This is a validity date, 15 January 21st, which is 40 days away. I am sell this put contract, the bid and the ask is 2.08, 218. Let's say it is 210, for example. So if you sell this put option contract, which is valid for next 40 days, because you sold a contract, you collect premium. You collected $2.10 per contract. It has got 100 shares underneath it. You get $210. So that's how option works. So these numbers, which you see here, will be multiplied by 100. So you sold this option contract, you collected $210 upfront today. And you also took on an obligation to buy the stock at 45 if the buyer of the contract exercise their right. If you are assigned that contract, you will end up buying Snap at 45, which you are anyway okay to buy Snap at 45. So from your perspective, no difference. You will end up buying at 45. That's the worst thing that can happen. So let's look at various scenarios. Okay, I just saw there was some question on the chat, and there's nothing. So let's look at various scenarios, right? What could happen? Okay, question, who defined the put option pricing? This is defined by, we'll probably cover later in cycle, where we look at how the option pricing is defined. Various things goes into option pricing. What's the underlying stock, where the stock currently trading at, right? If it is at 50, your option pricing will change if the stock moves from 50 to 52. What's the time period you're looking for? The option pricing for January will be different for option pricing for February. So let's look at 45. Let's look at 40. So 40 option pricing is 48 cents and 52. Let's say between it's 50. Go to the later expiration period, April, it's gonna be different. So it depends on what's the expiration period, what's the strike price, what's the volatility, what's the interest rate. That's where the whole Black-Scholes model come in. We don't have to worry about it to calculate it because we see the option pricing right here. Black-Scholes, they got a Nobel Prize when they gave the option pricing calculation formula to the world. So I don't want to get into the details. If you're interested, I will show you the formula in one of the sessions of option pricing calculation formula. But like I said, we are retail investors. For me, the pricing is what I see on my trading platform, but that's how it is calculated. And then big factor is the volatility. And of course, what's your strike price? What's the date of expiration? Is the strike price always round numbers? No. In some cases, I have seen some ETF. They have sometimes 45.73. I don't know why that is. I haven't yet figured out the answer for it, but most of the time it will be round numbers or it will be in increments of 50 cents. It depends upon how much interest is there, especially on the stock side, on each of the strike price. Then the market makers will come and make the markets on that. All right, let's continue. So we were on an example of selling a put option at 45. Now let's look at various scenarios, right? What could happen? Why should you do one versus other? And I'm coming from engineering background. We always want to look at an options. We want to look at the mathematical proof of, tell me what what the scenarios are and how it will work out in each scenarios. So if you have done a limit buy order, stock has remained unchanged. Stock was at $48.10. Now you're on 15th January, 2021. Hopefully COVID will be under control, but let's see. Stock has remained unchanged. It is still 48.10. Your limit buy order, you don't get the shares because the share is not come down to 45. It has stayed at 48. But you're not compensated for your time. Okay. Your portfolio is still having only $4,500 in it. No profit. Portfolio value started at 4,500, ends at 4,500, zero return on capital. Let's look at other case. If you have sold a put option, you still will not get the shares. Why? Think from a perspective of whoever has bought that option contract. If the stock is in the market at $48.10, why will I exercise my right to sell the shares at 45? If I'm an option buyer, I'm not stupid. I will rather go and sell the shares at 48 in the market. So if you had sold that option, you will never get the shares because the buyer chose not to exercise her right and the option expired worthless. I'm not stupid that I want to exercise my right to sell the shares at 45 when I can sell the shares at $48 in the market. So why I want to go through this exercise right process? No, this option will expire worthless. So the other side of the transaction were you who actually sold this option because you sold a put option. So if I don't exercise my right to put the shares to you, you don't get the shares. But remember, you got upfront premium of $2.10. No one is gonna take that away from you. You already have that in your bank on the day when you sold that put option, which is, let's say today, if you're selling that put option, you already got that money today. So when during the expiration period on 15 January, you still have that money. No one is going to take that money away from you. So if you didn't do anything in your portfolio, you got paid to wait. Your portfolio value now is 4710. 4500 was the money that you brought in because you wanted to buy 100 shares of Snap at $45. But instead of doing a limit buy order, you sold a put option contract. You received a premium of 210. You didn't get the shares because the shares didn't go below 45. But you got 210. That's yours to keep. Your portfolio is 4710. So you still ended up net positive return on capital, even if the stock hasn't changed. Stock is unchanged, but your portfolio gave you some return. But stock can go up, can go down, can remain unchanged, right? So to be fair, let's look at other scenarios. Next one, stock could go down. It was 48. Let's say CEO, Mr. Spiegel, he came and said something on CNBC. Analysts didn't like it, investors didn't like it. They pushed the stock down. Now you are sitting on 15 January 21. Stock is at 43. Your buy order would have got executed. You got the shares at 45 because the stock came down, and whenever it hit 45, your order got executed. You got the shares in your portfolio at the cost of $45. But your portfolio value now is 4,300 because the stock is now trading at 43. So your portfolio is at loss now. You started your portfolio with 4,500. Now the value of your portfolio is 4,300. Let's look at what happens in this scenario when you sell a put option. You got the shares at 45. You earned a premium of $210. So now your portfolio value is, you got 100 shares, which is now worth 4,300. Plus you had the $210 as a premium. Your portfolio value right now is 4,510. So you're still a little bit positive because the stock has gone down only $43. Right? If it had gone down way further, yeah, you would have lost money even in here, but you would have lost less if you would have just had a limit buy order. So in this case, you are still net positive ROI. Let's look at other scenario. What if the stock goes up? Let me see any questions. Oh, okay. So yeah, someone said it will end at 4,700 because of premium. Yep. Third scenario, be fair. Let's say stock could go high. Why does it go down? It could go high also. That's what Snap has been doing. It is an all-time high right now because they put up some good numbers. So let's see what would have happened in limit buy order. You were at 48. Stock has been marching high and high. Your order never got executed. You were not compensated for waiting. Portfolio value stays at 4,500. No change in that portfolio value. No return on capital, or I would say zero return on capital. Let's look at what could have happened if you had sold a put option. You still didn't get the shares. Same logic. Why would someone sell the shares to you at 45 when they can sell the shares in the market at 55? So you're not going to get your Snap shares. Sorry, if you wanted to gift it to someone, you don't have that. But you would have retained your premium. So your portfolio value is still 4710. You still ended up with positive ROI. So I don't understand for me, instead of putting a limit buy order and waiting, I would rather want to get compensated while I wait. So you could sell a put option, which will do the equivalent thing as of you buying, if you are okay to buy at that price and want to hold it for a long term. So this is one scenario, which I said, this is how you can acquire your shares at lower than the market price and get paid while you are waiting for shares to come down. If shares don't, it doesn't come down to your buy price at which you want to buy, it's okay. You got paid something for waiting at least. Okay. So this is called cash secured put. This is a very basic, I term it as a newbie strategy, because if I have been buying stocks, it allows me to buy the stock at the price at which I want to. I will pick how long I want to wait, and to wait, I get the premium. I get the money to wait. So instead of putting limit order, maybe you could sell a put option. You choose the strike price at which you want to buy the stock. So let me bring up my trading platform. Say we were in, where's January? 15 January. We are still on Snap. Oh, Snap finished today at exactly at 50. So you choose where you're comfortable to buy Snap. Buy at 45, then you can sell a put at 45. Today, right now you're collecting $1.43 as a premium upfront to sell it at 45. 38 days out. If you want to be more aggressive, you say, I don't mind buying it at 50 because I can go and buy today, but I don't mind waiting for it. You could go and sell a put at 50. You choose which one you want to do. You could collect $3. Maybe you take a midpoint, say $3.50. I'm taking the worst case scenario, which is at a bid. You collect $3.50 for selling this put, which means if the stock goes below 50, you will have to buy, you will be assigned the stock and you will have to buy it at $50, which you are okay to buy anyway. So if you have some stock that is long-term you want to buy, you have a price point in mind, instead of showing limit order, maybe try to sell a put and get paid for waiting. Say if the stock stays above this, I anyway got my $3.50 upfront on $5,000, which I'm blocking for this, which is, I would say, a decent premium. $3.50, $350 for the whole option contract for a $5,000 amount in 38 days. Way, way better than what the bonds or the CDs can give you. But do it only if you are bullish and if you want to acquire Snap. Okay, I see a question. All right, one question I see. Consider that would have happened if you bought with the market order and the stock went up 55. So, I don't know at what point of time will this came along. So if you could, I'm not sure what does that mean. What could have happened if I bought with the market order and the stock went up to 55? Yeah, in that case, if you had bought at a market order, which is 48 and went up to 55, great, it worked out for you. But that it means you actually know where this, if you are very sure that the market stock is going to go high, and if you are okay to buy it at current market price, go ahead. For today's session, I will say go ahead. But you realize most of the time we are very bad at picking directions. Nobody can predict where the market could go. Okay. Forget about what we are seeing in 2020. This is not normal. 2016, 2017, 2018, there was no movements in market except 2018, December, where the market fell down. Things were not even having these big movements, what we're seeing in 2020. So 2020 is aberration. But if you think you got a crystal ball and you know that Snap will go high and you're okay to acquire it at 48, go ahead. In that case, buying the stock probably would work better, because by selling a put, you will only get $350. But if you bought a stock and it goes to 55, you probably made $5. But only if you know that the stock will go. I can't predict. All right, let me look at the next question. Is the $4,500 free until expiration or held up? It's a cash secured put, so it is held up. If you're just starting on your option trading, it is held up. So similar, if you put a limit buy order, your money will get blocked for that. You won't be able to put other order. This will be held up. That is why this strategy is called cash secured put, because this order is secured by the amount of a cash that you're holding. Okay. Also, can you cover the scenario where the price went 43 and then went to 55 by Jan 15th? So if price goes to 40, we can talk about it in later sessions, but the way it will happen is, let's say if price goes to 43, say on December 31st, your option contract may not be immediately assigned. So there are things that we will cover, which says when you are at a risk of assignment, your limit order could get executed immediately. Say the stock is at 48, stock goes down to 44, your limit order gets assigned immediately. But if your option contract may not get assigned immediately. And that depends on the other factors, which we will refer later when we look at how do you find out if your stock is at risk of assignment or not. So we need to talk about extrinsic and intrinsic value. So we'll cover in the later sessions. Okay, question. Another one is, if the stock dips below the strike prices temporarily, then spike up, can I still buy it, or I need to act in that window? So let me know, you can buy what? You want to buy the stock or you want to buy the option? You can buy or sell options anytime, or you can buy or sell stock anytime, whenever you want to. I mean, there is no restriction, if I'm understanding your question correctly. Or if you are selling the put, you don't have a right. You have to wait if somebody assigns the stock to you. So in this case, let's say if the stock dips below the strike price and then temporarily spike up, if it is being assigned, then you will get the shares. If it is not assigned, you don't get the shares. Remember, you cannot exercise the put because you're selling a put. Though whoever has bought a put, they have a right to exercise. As a seller, we are obligated to perform what we agreed to. So we don't have an right to exercise. Question, I can lose on the upside, which in case the market order is less likely. Yeah, if the stock, for example, if you know, like say at a stock is currently at 50 and you sell a put at 50, you collect $3.50. If stock goes at 60, yeah, you missed out on that upside. Okay. But let's understand, again, I don't want to jump the gun here. We're going to talk about the probability. This whole options is a probabilistic way of trading, right? If looking at this number, right now I can tell you right now the market is pricing that there is a 20% chance that the stock will go to 60. Market could be wrong, but right now the market is pricing that it is 20% chance that will go to 60. Now, do you want, what type of investor you are? Do you want to swing for the fences and take your chances with maybe it could go to 60 even though there's 20% chance? Or are you the type of investor who would say, hey, I would like to play, give myself some cushion, some room for error, and agree to buy it at 50. Even if the stocks fall down to 48, I'm still profitable. But if stock goes to higher, I still made my $3.50, which is whatever percent, 8-9% in 38 days. So that's something you have to think what type of investor you are and decide based on that. But yes, if you sell a put option at 35 at here and the stock goes to 60, your maximum you can make only $350 or $3.50, not more than that. I hope that answers the question. Okay, I see the next one. In this case, I had to wait till 15 Jan. I could have used to buy other stock, another better stock. Am I wrong? No, you're not wrong. If you are selling this put, you will have to, your money is blocked because you have a cash secured put. And again, right now, whatever I'm saying, I'm assuming you are a beginner in options. So the trading privilege that you will get is level 2, which means you could do cash secured put. So you need to put up the full amount of money for selling this option. Once you advance into margin level, then you only put up 25%. Once you have enough option experience, you pass some of the test with them, and you get a portfolio margin. I put up only 15%. Money for me, only 15% get blocked. Okay, but before you reach that stage, you need to understand how to manage risk on overall portfolio, etc. But yes, if you are selling this put, 5,000 will get blocked. Same is the case if you are selling, putting a limit order. So if you want to reclaim it, buy the put back and close the transaction. So I can, if I'm sold a put, I can go and buy the put anytime. I can buy the put back anytime. I might have made some money if the stock cooperated, if the volatility cooperated, or if the stock has gone down, I might make some loss, but I can close the put anytime I want to. So if you are opening an option transaction, that doesn't mean you have to hold it till the expiration period. Your mind have changed. You don't want Snap anymore. Okay, close it. You could just, once you have the, I don't know if this is a simulated environment. Do I have any options? Or I'll have to log into my real. Okay, so there's something. So for example, XLF. Okay, so there is, what's there on XLF? Okay, $22, 2 puts have been sold. So anytime if my mind changes, I don't want to have a put option on Snap, I can anytime come and say, create closing order. I'll close it. Because I want to use my money somewhere else, I'll close it. So you can change your mind anytime. You can basically reverse the transaction, or you can buy back the put anytime. Now, depending on what has happened since you sold it, you might make money, you may lose money. But that's the case if you also, buy stock and your mind changes, you want to put your money somewhere else, you could do it. Okay, can you please explain the platform? Yeah, so I think there is one session I can take where we talk about the whole option chain. Maybe then I think we have some time I can talk about it, but let me look at some of the other questions. Okay, there was a question, can it be bought at the same premium? May or may not be, depends on the markets would have definitely changed. When you sold a put, Snap was 48.10. Snap could have moved down to 44. Snap could have gone to 40 or 55. So your option premium will change. So when you're buying it back, that is why I was saying, when you buy it back, because you're no longer bullish on Snap. You don't want to keep an bullish option position. You don't want to have your put position on Snap because you don't want to buy Snap anymore. Close your option position on Snap. And you could close it for profit or loss, depending on how the market have moved by then. Okay, I see another question. If I select the strike price of 70 and sell a put, I will get assigned only the stock price hits 70, else I will get to keep the premium of 2025. No. We are talking about you're selling a put, means you are giving someone else a right to put the stock to you at 70. Okay, so this could be assigned very soon. I don't see the extrinsic value here. So, but stock doesn't have to go to 70, right? If I am a put option buyer and I want to get rid of my shares, which I have in my portfolio, I will exercise my right. Say you sold this at 70 and I am the one who actually bought this put option contract. I will immediately exercise my right to put the shares to you at 70 because today the shares are at 50 in the market and it could go down. So it's not that a stock has to go all the way to 70. There is a different concept. You need to look into the extrinsic value. I don't want to get into that right now because we haven't covered any of the basics of how to identify whether you could be assigned or not. But that's not the way it will work. So we will talk more about it. Today is our first session. We just want to give a little introduction on, instead of, if you are, all of us, I'm assuming you are familiar with putting a limit buy order. See if you like a stock in which you can sell a put. And we can chat more about it on Slack. And there are a lot of other people who have gone through the same process, could help you as well. Okay. So what happens if you sell a cash secured put? You choose a strike price. You choose a time period, how long you are willing to wait. And you collect the premium money because you're taking an obligation, which means you're also taking a little bit of a risk. You're holding up your capital. You're taking the risk of that, come what may, you are obligating yourself to buy the Snap at $45. And for that, you are being paid. No free lunch. You're getting paid because you're taking that obligation. Yeah, so if you sell, which is expiring 40 days later, you would have collected $210 as a premium. Takeaways. I'll come to those questions. Let me just do that. Selling put is a share acquisition strategy at a desired price point. So I still want to be invested in stocks, but I'm looking for, instead of me putting a limit buy order and share never hitting my order price and I don't get the shares, how do I get paid while I wait? Selling put is one strategy in which you do this only if you want to acquire those shares. Okay. As a beginner, I sell put all the times with no intention to acquire shares. That's different. As a beginner, you should do this only if you want to acquire the share at your price point. It reduces the cost basis because you collected a premium upfront. And this is not taxable cost basis. This is cost basis means if you get assigned the shares at 45, your actual cost of owning that share is 45 subtract $2.10, it's $42.90. So your ownership, TCO, total cost of ownership of the shares will be reduced by the amount of premium that you have collected. But if you have put a limit buy order, your TCO will be $45 because you didn't get paid for waiting. So I refer this strategy as a transition strategy because it helps. It helped me as a stock investor to slowly dip my feet into options and became an option investor. You won't see anyone referring as an option investor. People generally have a negative connotations when you talk about options because they think you are a trader. I'm not a day trader. We can't be. With the jobs, etc., that's not what we can. But using options has allowed me to become a better investor in terms of acquire shares at less than the market price at a lower cost basis. If I don't acquire, I made some money. May not have made tons, but I made some. And who is to say that the stock will go to 60? Toll Brothers, excellent result. Stock is down 8%. We never know where the stock will go. So I stopped guessing where the stock will go. And then later on, we will talk about more strategies where you can play on the both sides of the market, right? So that's a different one. All right, let me address some of the questions. In your Snap 45 example, when is the stock assigned? End of the trading day, when the contract expires. So now, because you asked this question, I'll tell you the right answer. You may not be able to understand, so just you will be able to understand when we start getting into little more details. So generally, you get assigned when the extrinsic value in an option is very less. So we will talk about, so remember, you got paid $2.10 for $45 snap. So the person who has actually bought that contract has paid $2.10. Right? So they will put the stock to you only if snap has gone below $42.90, because that's when they become profitable, right? So example, you are an option seller. I was the option buyer. Say I am holding stock. I have a snap in my portfolio and I wanted to buy some protection for it. You were selling me protection. So I bought a put from you so that I can sell my snap stock to you at 45. For that, I paid you $2.10 upfront. Okay. So the stock goes to 44. Why would I exercise my option to sell you at 45? I mean, it's still not profitable, because once I exercise the option, I lose that right. Stock could go further down to 42. So I want to wait. Only if the stock goes very low, that's where you become more chance that you could get assigned. So it is not that the stock falls below 45, you immediately get assigned. So you need to look at what's the extrinsic value. And again, we'll talk about it in subsequent sessions. Also, when is stock assigned exactly at 45 or price close to it? No, so when the stock is at whatever 45, you may not get assigned, because if think from my perspective, the moment I exercise my right to put the shares to you, I've lost that right. And from, let's say we entered into this transaction today, stock went down to 44 tomorrow or 43 tomorrow. Now I am thinking, should I exercise my right and sell the shares to 45? What if the stock could go down to 40? I have a right till 15th of January. I don't want to give that away now. So there are these decisions happen based on the extrinsic value. So I may not exercise it right away. So if the stock goes down to 43, it's not that you will get exercise tomorrow. There are ways to figure out when you could be at a risk of assignment. We will talk about in subsequent sessions. This can be done only in 100 share increments. Yes, unfortunately, that's options currently are not, don't trade in fractionals. So it would only be 100 share increments. Except, like I mentioned earlier, there are some cases in which the reverse splits and the stock splits have happened. Those contracts, if those are still valid, those could be where it could have only 25 underlying on the old prices, but ignore all those. That's just noise. 100 shares minimum underlying. When does the buyer's right end? So when the market closes on the day of expiration. So day of expiration is generally third Friday. And I'm only talking about the equities. You will see many, there are some weeklies, etc. Let's ignore that. Let's focus on the regular expiration, which is every month, third Friday. So this is 18th December, expiration month is 18th December, which is December 1st, 2nd, 3rd Friday. Next will be January, 3rd Friday will be 15th Jan. In between, you might have a weeklies, ignore that for now. So these are weeklies. We don't want to focus on weeklies right now. April, 3rd Friday. So they will also open it up for February, probably later. But right now, April, 3rd Friday. So the option buyer right will cease to exist after Friday. So generally, depending on what brokerage firm you are with, you might have 30 minutes after the market close to call up your trade desk and say, I want to exercise it. But after that, it's gone. Expiration gone. Your right is gone. Okay, see another question. Naked put would require highest option trade level. I think level 3 doesn't allow naked put. No, it's a naked call that require the highest option privileges, not the naked put. Naked put is, you have to have it as a cash secured, which you will get it with a level 2 privileges also. So that's, it's a naked call which requires the highest level because that's got the highest risk. We'll talk about that. We'll talk about call, but I don't want to talk about naked call. As a beginner, you should never do naked calls, trades. Those are the trades where people, let me put it, they destroy their portfolio because they don't understand the risk behind it. Once you become comfortable, you know how to manage the risk, then you can do the naked calls whenever you want to. But naked put is fine. It's a cash secured put. You can do it in IRA as well. Okay. Well, let me see any other questions. Okay, one more question. If I sell a put option and I got a premium, and 2 days later, I want to cancel this put. So what happens money wise, it will depend on you can cancel the put means you can buy back that put. So the money will go from your account based on at what price you have to buy that put. So when you sold a put today, your account gets credited with the amount of premium you received. 2 days later, you changed your mind. You buy back the put. Depending on the market situation, you could buy it back at lesser than the price at which you sold, in which it was profitable. Or you have to buy it back at the higher price at which you sold, in which it was a loss for you. When you do that, the money will be deducted from your account. Okay, there was a question around bid, ask, call, put. The reason why I didn't get today is because we haven't touched calls. But if there are no other questions, let me quickly. And this is a trading platform that I use. Any option trading platform, any brokerage platform house that's supporting option trading will have these basic elements. One is called option chain. And this, what you see is an option chain. It's called chain because you will see a chain of the strike prices listed out here. On the right hand side, you have a puts. On the left hand side, you have a calls. For now, ignore all this delta, gamma, etc. I mean, I can get rid of it probably. Let me just have these two. So bid and the ask is similar to stock bid and ask. Bid is the price at which if you want to sell it, it will get sold immediately. Ask is if you want to buy it, someone is willing to sell you at this price. Generally, if it is a very well-traded stock, we try to get to the mid price, same concept as we have in a stock. These are the pricing which is set by the market makers. If you want to sell a put, I click on a bid or I select a put, and then I can change my pricing the way I can change it in my stock. I can change it. I can set the limit price or a market price, etc. Okay. So this is called option chain. Depending on what platform you have, you will have an option chain. You can say bid, ask, show you volume, what's an open interest. Just like on the stocks, you can see how many stocks got traded. You can also see how many option contract got traded today on this strike price, 618 option contracts on this price, 245 option contracts at strike of 47. Like I said, you can pick and choose what strike price you are comfortable with and trade on that. This is the platform which I am showing right now is Thinkorswim. Tons of tutorials available on YouTube on Thinkorswim if you have Thinkorswim. What are those alphabets next to bid and ask? This shows the what exchange has this. But again, I don't know whether the other trading platform shows this level of detail or not. Thinkorswim is very detailed. By the way, this other alphabets never play any role in decision making. So, but since you asked, this is what it is. It tells you this is a code for an exchange. There are multiple exchanges for options. They tell you which this price is coming from which exchange. By law, they have to show the national NBBO price, which is national best bid offer, something like that. So they will tell you which exchange is it coming from. Okay, so let's focus back on options. Like I said, if you want to know more about Thinkorswim platform, there are tons of tutorials available on Thinkorswim. But if you have other platform, you can learn from on other platform on how to find this information. In one session, I'll talk about what to focus on in an option chain and what are the things that you can ignore as a beginner option trader. Right? Sometimes it could just become overwhelming. It's like a cockpit and there are so many instrument panels. I don't know where to focus on. I'm just new. So you have to become comfortable. For now, just look at the bid or the ask. For if you are only doing the cash secured put, just look at a bid and ask. That's it for you. Is there a crypto derivatives market? Yes, there are Bitcoin futures are listed on CME, but those futures are too big in the notional size. But that's the only one which I'm aware of. There are derivatives market which are not regulated because those are outside of US exchanges. I don't trade derivatives on cryptos anyway. So, and I won't recommend trading on derivatives crypto on other decentralized or DeFi exchanges. Too risky. Many of them are unregulated. You don't know when US government might shut them down or might prohibit US residents from dealing with it. So be your own judge. I don't do that. Okay. All right, so no further questions. So homework. I said at the beginning, you'll get an homework. If you don't have an account enabled for option trading yet, please go ahead and enable your account for option trading. That's the step number one. Otherwise, all the future sessions we're going to talk about, you'll be just wondering what's happening because you won't be able to go and check or do anything. So first step, enable your account. I'm going to put oops, where's this video gone? All right, just give me a moment. I just want to give you, maybe link for this. Oops. So like it said, there are ways to get a little better privilege, option trading privileges. So I did put out a video long back. So before you not negotiate with the you might have to negotiate with your broker, but before you start answering the questions on your option privilege request form, go through this video. So there are some tips and tricks which could allow you to have a better option trading privileges. Might work out for you. I mean, it's 20 minutes, so not a big deal. It might be worth to going through this before you fill up the form. Next, once you have your accounts enabled for option trading, find out, is there a company on which you would want to buy 100 shares? Go and sell a put option. Pick up a strike price at which you are comfortable in buying it. And maybe pick up expiration period at which you are comfortable for waiting for that period. And then sell a put option. In that case, shouldn't have a remorse if a stock suddenly go high or suddenly falls down because you were comfortable in buying that stock at that price. So if a stocks fall down, you should still be okay. So pick up the stock accordingly that you are willing to buy it and hold it for some time. Okay, that's it for today. Let me see any other questions. Okay, so would you recommend a paper account? So I say use paper account to become familiar with the trading platform. I don't recommend you trying on a paper account for next 2 months, 3 months. Stay with the paper account for 2 weeks so that you know where do I need to click to find a particular information. How do I place a trade? How do I cancel a trade? How do I find bid-ask spread? How do I look at the chart? Use that to understand how the trading platform works. But unless you have put your feet in the real account with money, you will just not get, I would say, the real feel of how the market works. Because in a paper account, you're trying to sell a put, it will immediately get sold. In a real one, it may not. So you may have to change your pricing a little bit, give away some penny or two. So in a real account. So paper account, sure, use a paper account to become familiar with the system. And then move over to real trading. Can you please show the HW slide? Sorry, oh, the homework slide. Okay. Coming from a tech background, I'm like, which hardware slide? What hardware did I show? Okay, I know this is unrelated. How do you feel about Airbnb IPO? Okay, we are done with this, so I can talk about it now. Airbnb IPO, I had reviewed it in 2 weeks ago, our Saturday session. So that's where we review what's happening in the market. We done a review of DoorDash, Airbnb, Wish, Affirm. We talk about what's happening in crypto. We talk about actual option trades, etc. But my feel about Airbnb IPO is I would want to wait and watch. The reason they had to push out IPO so soon, one of the reason is that many of the early employees were getting their options, their stock options expire. They were reaching their expiry date. So they were pushing also the management to go through IPOs. Airbnb has allowed their employees to sell 15% of the shares without a lock-in, which is generally not the case, but in this case, they have allowed to sell it. From a revenue perspective, etc., I think they've done a good job in terms of getting the initial bookings. Their revenue were more than what they had expected. But I still want to wait and watch for at least a couple of quarters for them to see how they come up with. I'm not a big fan of investing in IPOs because for me, if it is going to be a market beater, there will be plenty of opportunities to invest it later. As an outside investor, we have the least amount of information. We have the most decked, the most well-staged house, which is a S1 document, which I read through. So all the odds are tilted towards the company. That doesn't mean to say that once the Airbnb get listed, won't go up 40%. Today, anything and everything is going high. So it's a crazy market. But I am staying outside of Airbnb. I looked at it, I reviewed it on a meetup. You could go and see that. I don't recall, I think it was 3 or 4 sessions ago. We did a deep dive review of Airbnb IPO. Question, typically, how soon IPO stocks become available for options depend upon stocks and how much the interest is. If there is more interest, then there are more market makers and then becomes available for IPO. There is no set timeline as such. Technical analysis in later session, I don't focus too much on technical. I can share in terms of, let's say, some of the indicators that I use, but those just give me direction. I focus more on the other stuff, especially when you're dealing with options. I focus more on volatility, what's the volatility in that particular stock, or at least in some cases the price extreme. But let me put it this way: technical charts come way lower in the decision making when I'm putting an option trade. But I can talk about in terms of what I have and I use. And sometimes it works, sometimes it doesn't work. Many of the indicators are generally, they're lagging indicators. So if you think it's going on above the upper band of Bollinger Band, who has to say that it won't go higher, right? Shilpa say how to join your Saturday session. If you're Shilpa, then, sorry, I think you're on a meetup. If not, let me just pull up the meetup. Hold on. So I schedule all the sessions through the meetup. There we go. So this is our group, Paradigm Option Traders. And for example, so if you look at the past ones, this Saturday we reviewed we did a pre-IPO review of C3.ai. We talked about how to prepare your option portfolio for holidays. We reviewed Affirm and Wish. Prior to that, we reviewed DoorDash, Airbnb. So if you are on this meetup, you will get a notification. So generally I already have scheduled the Saturday session, they are already on the calendar. I just will update the agenda or the content, what we're going to talk about based on what I see in the market. And generally this I'll update it on, Friday evening or Saturday early morning. But all those events are already scheduled. What I have to schedule is this boot camp. Right now we only have this session scheduled. I will schedule the other ones also. Is level 2 for option trading okay for now? I think that's, is it the best? No, but probably you won't get more than that. And again, level 2 and level 3 definitions could be different based on which brokerage house you talk to. But if you never traded options, then they will give you an option privileges in which you could only do cash secured put or covered call or buy call options and sell call options. That I think is level 2. In some cases, they may refer it as level 3, but these are the minimums. These are the maximum privilege they will give if we're just starting on options. So go through the video and try to see how you should intelligently answer the questions so that you can get the best option trading privilege. You may not use it, which is fine, but it is always good to have privileges in our toolbox, even if you don't use it. The problem is if you don't get it now, later on, then you have to negotiate it, and then, it becomes a little more difficult. So maybe answer those questions more intelligently right now. You're welcome, everyone. Hopefully, I was roughly good. I will try to do better next time, and we'll do another session. Earlier, I was planning for 2 sessions per week, but maybe I'll do another session, 1 session per week for now, and see how you're catching up with it, how it's moving ahead, and then can switch to 2 sessions. So it's going to be a long ride. But if you are willing to commit your time and effort, I'm there with you to share my experience. It's going to be 12 to 14 sessions. We got to cover so much. So stay with me. Cool. Welcome, everyone. All right. So I'm seeing questions around the excessive price of companies, Palantir, Tesla, etc. Markets are on wheat from Fed. There is a cheap, easy money. Number 2 is a lot of these things are driven by new traders who are buying call options, which is then forcing market makers to hedge and buy stock. Will this thing continue forever? No. We don't know where it will end. But like I always talk inside of these sessions is, I'm hedging my bets. Am I completely getting out? No. Because I don't know, it could go another 5% higher. But I'm protecting using options so that if it goes down, at least I'm not hurt as bad. So that's my viewpoint. All right. Cool. Thank you, everyone. And I'll see you next Tuesday. I'll schedule that session. Hopefully, please finish your homework and try to go through, I think on my website, there is already a recording of a previous boot camp. So if we at least go through cash secured put or options, the basic option contract will be helpful because you'll have a quiz next week. So I'm not going to leave you just like that. Okay. All right. Yeah, it will be same time next week. I will schedule it on the meetup. So you should see that coming in. Let's stop it right here. Thank you, everyone. Let's talk again next week. Those who are on Slack, we can chat and continue to interact during that time, on Slack. Goodbye. Good night.